All right. Today is Thursday, February 9th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's start by this. What's going on with the bull market? It doesn't seem like it's holding right now. It seems like it's falling apart all of a sudden. And what happened today is we got a gap and crap. We got a pop in the morning. Folks buy the futures because the dollar is down. But mind you, the dollar is down because other currencies are moving higher because the central banks of those countries are pushing rates higher. We're talking about the Australian dollar was shooting higher in the morning. The New Zealand Kiwi, same story. And of course, the dollar went down. And the algos, the dummies that they are, they see the dollar down, they buy the equities market. And then the traders look around, the mom and pops look around and say, okay, I guess we're going higher again. And they buy and then boom, they fell into the trap. Now, we have a lot of rumors in the market that, hey, we got the gap and crap and the massive pop that we got today in bond yields. And that's because Carl Icahn, aka Gordon Gekko, made a massive trade betting that the CPI, aka the CPLI, will pop higher next week. Now, I don't know if that's right or wrong. I don't know if that's the case or not. All I know is we called this the monkey rally because it's monkey see, monkey do, with no reasoning at all. But now that the rally stalled, there is a process of thinking. And folks who were just being indulged in the mania and saying, oh, this is a new bull market, higher we go. These are the pros, by the way, the professionals. Now they're looking around and saying, okay, let's be honest here. Bond yields shooting higher. Dollar shooting higher. It looks like inflation is rebounding. Corporate earnings in the toilet. So is this really an environment where we're going to buy stocks and assume that this is the bull market starting again? No, it's not. And they start to de-risk. And some of the mechanical elements of the rally, such as the gamma squeezes, the short squeezes, that also comes to an end. And who's left holding the bag? Yep, you and me, baby. The retail crowd. And this has got out of control. It's an absolute mania, reminiscent of the .com, or even, let's not go as far as the .com, let's just go back to 2020-21. We have an IPO mania. Today, the new solar something company, IPO, popped higher by 20% or so. We have an AI mania. Every company now has to say, hey, we're doing ChatGPT too. And boom, the stock shoots up higher. And a company can now say, hey, we are an AI company. Bed Bath & Beyond. We're an AI company all of a sudden. We're going to use AI in our bankruptcy procedures. Stock goes higher. And of course, the lunacy is going on in Wall Street right now. All of the analysts, the experts, now they're bumping the targets. They're chasing the mania. They were talking badly about these stocks a month ago. Now all of a sudden they're chasing and saying, hey, we're going to go back to all-time highs. This stock is going to pop. That one is going to pop. Now they're upgrading the target from Microsoft to go higher by 16% based on ChatGPT. Did you look at the earnings of the company? The trend is slowing down big time. The dollar is moving higher again. Toxic waste right now. ChatGPT or no ChatGPT. And oh, by the way, with bond yields moving higher, there is no tolerance here for expansion of any of these valuation metrics. They have to go down. Microsoft is overvalued right now. But it's a mania, it's an indulgence, it is stupidity all over the place. But perhaps we're seeing signs that it's gonna end badly. That maybe today was the beginning of a reversal of some sort. And indicator number one is what happened to Disney. Disney opened higher by 7-8%, and then it closed negative by the end of the day. And that is a leading indicator that the sentiment in the market is shifting. And by the way, a lot of folks are saying, why did Disney go down? I'll tell you why. Changes sentiment, one thing. The other thing is the battle between Peltz and Bob Iger. That's over now. He got what he wanted. Layoffs. That's what they want. We have an unholy alliance right now between gangster investors, ruthless CEOs, and contracting margins. The combination of these three means more and more layoffs. Look at how happy they are that people are losing their jobs. Take a look.
These are exciting times. You know, Jim, my dad once told me that you can only win once. This was a great win for all the shareholders. Management at Disney now plans to do everything that we wanted them to do. We wish the very best to Bob, his management team, the board. We will be watching, we will be rooting, and the proxy fight is over.
Yes. Thank you for declaring victory in a gracious way.
And this is exactly what Peltz wanted to see. Yes, fire people. Fire more people, Bob Iger. And I believe that the fact that he's now declaring victory and saying, okay, we're done, that's what pissed off the market. The market wants to see the battle continuing because that means more layoffs to come. And the market wants more and more and more layoffs. Now, we know that Bob Iger is a repulsive character. Rude, check. Egotistic maniac, check. Lack of empathy, check. All signs of a psychopath, but he also makes a really good CEO for the stock. Forget about the company, for the stock. And the reason is he's ruthless. If he needs to fire 7,000 employees, he'll do that. 10,000, he'll do it. 15, 20,000, he'll do it. No problem. But what is the cumulative effect of all of that? When we see mass layoffs all over the place, that's recessionary. But nobody's paying attention right now. Indicator number 2. The mania is perhaps coming to an end here. It's going to end in tears. Look at certain stocks that popped higher due to short covering. And unfortunately, the mom and pop crowd, the retail investors, they don't understand these kind of things. When you have the most beaten up stocks and they pop higher in the beginning of the year, that is short covering. If you've been short companies like Carvana, or let's look at a firm, trash companies, down 70-80% from the top, you're sitting on massive gains. Now you're going to book those gains, but you're not going to book them last year because that means more taxes. You want to delay the payment of taxes, so you sell them in the next year, meaning this year. People who have been holding losses, they sold in December for taxation purposes to book those losses. The shorts sitting on profits, they sold this year for taxation planning too. Of course, the mom and pops don't understand any of this. They see a firm up by 50-60% and they have FOMO and they chase. This is the bottom. This is the bull market. But look at what's going on here in the recent runners. A firm, for example, was up by about 155% since the bottom, quote unquote. Look at where it is right now in a matter of days. They're taking them as fast as they gave you those gains. Now the stock is down about 45% since it topped, and it's happening so fast. Your gains are disappearing so fast. Here's another one. Lyft. Massive short covering rally year to date, and now the stock after hours down by over 30%. So when the retail mom and pops start to see this, it's a warning sign. It could cause the end of the buying FOMO, and we start a new FOMO in the rush to the exit door to book whatever profits you still have. And this causes more selling, and what happened to Affirm and Carvana and Lyft will happen to the big guys too. They're gonna cut the gains by half as we start to see the stampede to the exit door. So we have a change in sentiment here. Aside from the bond market, aside from the rise in the dollar, this rally is causing a lot of problems, which we will pay, all of us will pay for dearly. And the reason is, look at what happened to financial conditions. Raising the Fed funds rate to 5% should have been sufficient in restricting the policy and tightening financial conditions. But with the recent stampede, 5% is not enough. Now the Fed has to do more because financial conditions loosen. And this will cost the economy, and the recession that maybe was supposed to be mild, it gets more and more intense. As the stupid equities market continues to fight the Fed, fight the bond market, fight the macroeconomic conditions, fight reality, rates have to go higher and higher and higher. That ensures more and more damage to the economy. Now, imbecile Jerome Powell in the last FOMC said, oh yeah, the drop in financial conditions being loosened again. We don't look at these short-term movements. Financial conditions actually tightened by a lot. Oh, really? You gotta read a good piece by Mohammed Al-Arian in the Financial Times, and the title is The Paradox of Financial Conditions. As the Fed chairman, you can't really ignore the recent loosening of financial conditions. This is working against your objective. You gotta resolve that, and you could have resolved it psychologically by sending an aggressive message in the last FOMC. But of course, the genius that he is, Powell, he did not do that. He actually gave the green light for more and more indulgence and more stupid speculation. But now we're starting to realize that this rally is a fugazi. It's based on mechanical reasons. A lot of folks will end up holding the bag. When we look at monkey see, monkey do, you see the rally. But you're not asking why. We talked about short covering. We also have positioning by money managers. Now, for some stupid reason, money managers have to have neutral exposure. They can't have extremes one way or the other. By the beginning of the year, they were way underpositioned in the equities market. So they have to buy something. And they bought Meta, they bought Apple, they bought Microsoft, they bought Google, Amazon, Tesla, etc. Because they have to. But now they have neutral positioning. And they know what's going on in the bond market. They know what's going on with the risk of inflation rebounding. They know the risk of raising interest rates even higher than were previously anticipated. They know that earnings are shit. They know that valuations are really extended. So what they're going to do right now is book profits in these big mega cap names. And they're going to look back at their clients and say, look, we scored 20% in Meta, 50% in Tesla, 13% in Apple, whatever. See, last year when we lost a lot of your money, that was just an exception. We're back, baby. And then what happens? The retail mom and pops are the ones who are going to end up holding the bag. Because all what they did so far is monkey see, monkey do, monkey be all over you. Now let's continue this conversation with more data. And here it is in focus tonight. Watch your back, says Jamie Dimon from the Landromat. But before we start, let's continue the conversation about retail investors. Retail investors, after the rally that we got so far, are more bullish in stocks than any point since the Fed started hiking rates. Why? Are valuations better now? Do you see the end of interest rate hikes? Why the bond market is surging? Why the dollar is surging? There is absolutely no reason for the mom and pops to be as optimistic as they are right now, besides FOMO and monkey see, monkey do. The bullish sentiment now improved to 37.5%, which is the historic average. Now, did anything change in the macro environment? Did anything change regarding the Fed policy to cause such bullishness and optimism? I don't think so. And here it is, the retail mom and pops. They bought a lot of Teslas, lots of Amazon, lots of Apple, chasing all of these AI names, Carvana, Nvidia. They're just chasing. Monkey see, monkey do. And this is going to end in tears, folks. And unfortunately, the Fed chairman, instead of striking a tone of caution and rationale to market participants, instead, Chairman Powell fueled the mania by saying disinflation 11 times in the speech and declaring that the disinflationary process has begun in the U.S. economy. At the same time, Powell says a couple of years before the Fed nears the end of balance sheet decline. So you know that we have a long, long way in this tightening of the monetary policy. Why did you go out in the FOMC and gave everybody the impression that the job is done? And you're lying, you're just bluffing. That is the impression that you gave everybody, as if Powell was greasing up the retail mom and pops to be bagged. To begin with, the risk that the mom and pops are not paying attention to is the risk of stagflation. Maybe they are aware of it, but they choose to ignore it, and they're not the only one. Listen to Nobel economist Paul Krugman. This guy won a Nobel Prize, this propaganda tool for the regime. He's not really an economist, he's a propagandist. And he now says that doomsday economic predictions were wrong, and the Fed risks a recession if it tries to respond to imaginary stagflation. This guy won a Nobel Prize in economics. Now, even Stevie Wonder can see that the economy is in stagflation. So why is Paul Krugman choosing to ignore the reality? The answer is because he's a tool, corporate hack, and propagandist for the regime. What regime are you talking about, Maverick? It is the unholy alliance between the intelligence apparatus up Uranus and the oligarchy, and they rule the country right now. And by the way, this is the same guy who labeled anybody who demands fiscal responsibility by our government as terrorists. Think about that. If you say, hey, please don't gamble with my taxpayer money, please spend it responsibly, Paul Krugman is going to call you a terrorist. But anyways, what is all the fuss and excitement about? That, oh, inflation is going down, there is no recession, there is no stagflation, the Fed has to declare mission accomplished and move on. Based on what? The CPI going down 0.1% month over month? The CPI still at 6.5%? That's victory? That's it? Job done? It's over? Well, if you think it's over, you got another thing coming for you. To begin with, we talked about the Manheim Index. It rebounded higher for used cars in the month of January, meaning that used cars prices are moving higher again. And the most insane market in the economy right now is the auto market. It is absolute mania, the likes of the housing bubble in 07-09. Subprime auto loans, the shittiest scores, people paying over $1,000 a month in auto loans. And on top of that, I don't know if you saw this or not, car dealership guy says low-income consumers are getting squeezed. Here's a new disturbing trend we're noticing. People are buying cars and immediately canceling their insurance policy after the sale. Has happened to us multiple times in last month alone. This is absolutely reckless and dangerous. But the reason is insurance prices are moving sky high. Look at the stock of Progressive, for example, all-time highs, acting as a meme stock. Because all what they do is price gouging. You renew your policy, they're going to charge you more. And the worst is if you have a new title, if you have a new used or new car, you just bought it right now, they're going to charge you an arm and a leg to insure that car. So you're paying $1,000 a month in auto loans for a shitty car to begin with, which is going to fall apart in about 2 years. And on top of that, now you got to pay $300-400 a month in insurance. Tell me again that inflation is dead. You think this is going to stop anytime soon? Think again. When imbecile Powell says that the disinflationary process has begun in the US, what the hell are you talking about? Rents in Manhattan hitting all-time highs last month. I know, but inflation is dead, right? And the shocker today, we got the DPI, the Digital Price Index from Adobe. And guess what? Inflation moved higher in the month of January. Are you seeing the trend, by the way? The disinflation process that Powell is talking about appears to be transitory. And now we're seeing inflation moving higher again. Look at the categories. The month-over-month change, every single category went higher in price month over month, with the exception of flours. So okay, two of the prices went down. That's victory. That's over. We're done with inflation now. And by the way, what the hell are they talking about here? I went to the florist shop today, and I know this is the online prices, but I went to the shop today because we have Valentine's Day coming. I don't know if you heard or not. And they're charging $80. And I'm not talking about an arrangement here. I'm talking about a dozen roses. And I know what you're going to say. You're going to talk to your significant other and say, look, it's too expensive to buy flowers right now. So how about we skip that and get you something else? Gents, if you're listening, look, I'm no marriage counselor here. I'm no relationship expert here. I butchered many relationships before. But she's going to say okay. She's going to say she understands that it's ridiculous to spend $70, $80 on a bunch of roses. But next thing you know, this is what guys do. You're going to buy some dumb shit online, such as a samurai sword. You spend $300 because you think it's going to look cool in your office. She's going to see it and ask you, what is this? And you're going to brag about how special and unique this sword is. And then she's going to ask you, how much did you spend on it? And you're going to say, yeah, that cost me $300. Then she's going to remind you, but you couldn't afford $70, $80 to buy me some flowers. She's going to stick that knife right into your back and twist it and leave it there for the rest of your life. You'll be reminded about the stupid flowers that you skipped buying. So word to the wise, hold your nose, be a big boy, pay, and get the damn flowers. Anyways, when it comes to the disinflation process that we're seeing right now in the economy, look at food prices. Are you enjoying the disinflation that you see in the grocery store? Because President Joey B says that food inflation is coming down. Yet in reality, food experts are warning that food insecurity in America is on the rise. Now, why would it be on the rise? The answer is food prices are not going down, despite what the propaganda machine says. Even from the Fed, the Dimon from Minneapolis, Neil Kashkari, he also said that he gauges inflation by the price of Stouffer's frozen lasagna. Oh, really, Neil? This is Neil Kashkari playing poor. He's just giving you the impression that he actually eats frozen lasagna, when in reality, he has a personal chef. I mean, the guy pretends to be homeless. He's a common man type of guy. And he has the photographer with him taking pictures just for a few minutes to pretend that he's, the man of the people. And then he goes back to the mansion. And look, you might say, hey, the Maverick is a doomer, gloomer, boomer. He's just here into the drama and scaring folks out and all of that. Inflation is going down. The market is going to go back to all-time highs, and everybody's going to live happily ever after. Well, you don't have to listen to me. You can listen to Jamie Dimon from the Landromat, JP Morgan Chase, because he says it is too early to declare victory against inflation. Take a listen.
The current now economy is still doing okay. Consumers are spending money. They still have a lot more money. Their confidence is dropping. Their balance sheet's in good shape. Home equity is in good shape. Jobs are plentiful. That's pretty good. That's the now. It's being eroded by confidence, by inflation, and the excess savings is coming down. But I think a far more concern, when I talk about potential storm clouds, they're still there. QT and the effect of interest rates. Inflation may not come down like people think. Rates may have to go a little bit higher. But really, in particular, the war in Ukraine and what it's doing to oil markets, gas markets, food markets, poorer nations around the world, and the effect it's having on trade and economic relations between America and its allies, between America and China. And those are really complex subjects. I think it's perfectly reasonable for the Fed to go to 5 and wait a while and see what since it's a lag effect. But, if inflation comes down to 2.5%, people will declare victory. We're on our way to a soft landing, maybe. But, if it comes down to 3.5 or 4%, i.e. it's sticky, you may have to go higher than 5%.
Now, when we talk about stagflation, which genius Paul Krugman is denying, there are two parts of stagflation. Part number one is inflation sticking and perhaps moving higher. And the other part is the recessionary part, meaning you have inflation sticking higher while the underlying conditions of the economy continues to get worse. And of course, the bond market is now predicting that we're going to see a historic recession to come. We will look at the spreads in the yield curve, the 10s versus 2. This is the worst yield curve inversion since the 1980s. I wonder what happened back then. I can't seem to remember. But look at this. If the economy is indeed heading to a soft landing and the stock market is going to go back to all-time highs, the bear market is over, and the bull market is here, then why are we seeing the yield curve continuing to go down? Why do we continue to see the yield curve inverting and the inversion keeps getting deeper? Now, the yield curve has always been an accurate indicator for upcoming recessions. Why would it be wrong now? I know, because it's different this time around. We got the thing, we got the Gen Zers, we got the boot, we got whatever reason you want to throw and say it's different this time around. We'll see, because the propagandists, the corporate machine, they have no problem coming on TV and saying everything is fine. The economy is good, spending is plentiful, the jobs are good. there is soft landing coming. But watch what they do, not what they say. Because what they're doing right now, be it JP Morgan, Goldman, Bank of America, they're all preparing for a recession. And the layoffs that you're seeing in the economy right now is part of that planning. JP Morgan laying off hundreds of mortgage employees. We looked at the Wells Fargo earnings. We looked at U.S. banks earnings. The returns from the mortgage business collapsing, and it will continue to collapse because the yield curve inversion is saying the Fed is not doing enough. They will realize that 5% is not going to be sufficient anymore. They have to go up to 6, 7, if not 8%. And this will wreck the economy and annihilate the consumer out there. We talk about the tsunami of layoffs, part of the recession part of stagflation. Here's more for you. Yahoo says they're cutting more than 1,600 employees. But somehow that doesn't show up in the BLS Kitchen employment report. We talk about the strong consumer and the soft landing. What kind of drugs are you taking? What are you smoking here? Because half of Americans say that they're now financially worse off than a year ago. And this is the highest reading since 2009, back when the economy was booming. Remember that? If we're going to have a soft landing and the yield curve is just lying to us, who's going to stimulate the economy when the consumer is getting annihilated? But rest assured, you don't have to listen to me, the Perma Bears, the FUD crowd. You don't have to listen to Jamie Dimon either. You can listen to the geniuses at Goldman Sachs, who now say that the deeply inverted Treasury yield curve is not signaling a looming recession. These are the same people, by the way, who not last year, but 21, they said buy the dip as inflation is transitory. Are we going to believe you now that we're going to have a soft landing? Okay. Carl Quesadilla from CNBC tweeted this. And by the way, Carl blocked me on Twitter because I called him a corporate hack. He used to be a good broadcaster, but then he got the Trump disease, and now Trump lives in his head 24/7 rent-free. You know the deal. But he says, stop worrying about the curve inversion, says Goldman. We believe this cycle is different with an economy that can support a higher long-run real rate than currently assumed. If the economy stays robust, what are you talking about robust? The only robust thing is the mustard that goes into the hot dogs that Goldman Sachs is selling right now. But if you're saying, hey, Maverick, I know you're wrong. I know you're a perma bear, you're a FUD doomer, gloomer, whatever. But I can't believe Goldman Sachs. Can you give me another source? Well, here's Treasury Secretary Janet Yellen, who says that recession is not on the cards. We have a soft landing coming. Take a look.
Jobs numbers seem to defy predictions of a recession this year. Do you still think one is likely?
Well, look, you don't have a recession when you have 500,000 jobs and the lowest unemployment rate in more than 50 years. So what I see is a path in which inflation is declining significantly and the economy is remaining strong. And really that's a path I believe is possible, and it's what I'm hoping we will be able to achieve.
Finally,
I bet you feel comfortable that Janet Yellen now said that we're going to have a soft landing. Same lady, by the way, who said that inflation is transitory. So this is the crowd that you guys are believing. This is the crowd who've been wrong over and over and over and over again. Now you're believing them on the soft landing? I say good luck. And with that out of the way, let's move on to the coverage of the stock market information. We begin with the closing of the indices today, and here we go. The Dow Industrial Average up, down by 249.13 points, or a decline of 0.73%. The Nasdaq leading the pack to the downside, losing 120.94 points, or a decline of 1.02%. The S&P also down by 36.36 points, or a decline of 0.88%. When we look at the sectors, all down, all in the red, shame on all of them. Yet the laggards, led by communication services, aka Google, what a disaster that is, an embarrassment. Their lack of artificial intelligence is costing them over $200 billion. Unbelievable. And then we have utilities down because rates are up, materials are down because the dollar is up. But again, no winners here. And we also have distortions due to earnings. But we're going to get past earnings really soon. We're going to see which theme is sticking. Now let's talk breadth, because the NYSE 21% advancing versus 78% declining. The Nasdaq 24% advancing versus 73% declining. Folks, I talked about this in last night's video. The breadth has been absolutely horrible underneath it all. It has been only distorted due to the weighting of the mega caps. And this is exactly what technical analyst Katie Stockton said today. Take a look.
Well, I think they should be focusing on triple Qs or NASDAQ 100 and really the mega caps that drive it, because the mega caps have exhibited leadership on the last push higher. That last push higher allowed for breakouts in the like of Apple and Microsoft above their 200-day moving averages. And at the same time, we've seen breadth contract. So we're no longer really talking about the breadth surge that characterized much of January, but now we've seen actually pretty notable contraction in that participation, and that puts even more sort of onus on the likes of Apple, even Tesla in there too, all of which still have the support of the short-term trend following gauges. But I would be very, sort of carefully watching them, because if they do start to pull back, I think that that could impact the major indices in a way that we have not yet seen. And of course, market sentiment is at places where you could consider it to be overly bullish after January's rally really instilled some confidence in the tape.
On to commodities, with the dollar rebounding higher big time after big losses in the morning because the Australian dollar, I should say, and the New Zealand Kiwi were up. The reversal was stunning, and therefore commodities are down across the board. Energy commodities are down, crude down by 1% apiece for both the WTI and Brent, gasoline down by about 1%, heating oil down by about 2.5%. But natural gas is the outlier here, up by about 2.5%. We'll see how long the pop is going to last. Every time it pops, they shoot it down. But now we're getting reasons why gas prices in California are surging higher. Gas prices across the country moving down. The Henry Hub crashed. I mean, there is no other way to describe it. It's a crash. Yet gas prices in California up by 300%. What's going on here? Well, the headline from Bloomberg says California's surging energy bills are its own fault. And I say amen. To begin with, we have no storage facilities at all. Look at Southern California, nothing. We have all of these gas-fired power plants, but no storage facilities. You wonder why gas prices are exploding in California? It is because of the lunacy of Governor Kim Jong-un Newsom and his predecessors. They chose not to invest in storage facilities because, evil oil and gas. We're now paying the price. When it comes to softs, the notable decliner is lumber, down yet another 4.5%, but the rally in OJ and sugar continues with a pop worth about 1.5% for OJ, and then a little over 1.25% for sugar futures. When it comes to metals, we have divergences here. The dollar, with a big rebound, be it not positive for the day, yet the feedback is gold down, silver down, platinum down, palladium down. On the other hand, copper shooting up higher, with gains worth about 1%. But keep in mind, copper should be down when the dollar is moving higher. Yet we have massive shortages in copper. With the EV lunacy, the demand for copper sky high. But where is the demand? Peru not producing with the political chaos. Chile not producing enough. They have different politics altogether now. The mines in Indonesia already tapped off. No more capacity. So when you have a shortage of supply combined with sky high demand, there's no wonder why we're seeing copper being resilient. We'll see how long the resiliency is going to last, because the dollar is about to pop big time. When it comes to meats, no notable activities here, except lean hogs losing about 1% for the day. When it comes to grains, the winner of last session is the loser today, soybean oil futures down by about 2.25%, and the loser from yesterday's session, soybean meal futures, rebounding higher with gains worth about 3%. We have some softness here in corn, wheat, and oats futures as the dollar continues to move higher. Moving on to the big casino, the options market, and what do we see here? Absolute lunacy in Tesla, of course. The volume shattered the record, and it is a sign that the gamma squeeze is coming to an end, as the Johnny-come-latelys stampede and hold the bag. Over 4 million contracts traded for Tesla today. About 58% of those were calls. Why? Because they're stampeding. They have FOMO, they have Elon pumping again, and I promise you, Elon is going to dump. Elon is going to look at the action and say, you guys serious? You giving me a refill? I can dump $10 billion down to fund Twitter? Okay, thanks. But folks, before I proceed here, I made a mistake in last night's video when I said that the options contracts for the 200 calls exceeded the entire outstanding shares of Tesla. That was a mistake. What I meant to say is that the all-in-all volume for Tesla options exceeded the notional volume that traded for the name. In other words, when you look at the volume traded for the name today, about 214 million shares. Yet we have over 4 million contracts traded today in options. Now, in notional volume, that means 400 million shares of Tesla. That exceeds the entire volume that traded today. In other words, it tells us that the move in Tesla is done via options for the most part. It's an option stampede, it's a gamma squeeze. Most of it, at least the last run, is not based on legitimate buying. We know that gamma squeezes come and go. Gamma squeezes always end in a big flush down because premiums become really expensive and it takes a lot of buying, huge volumes to move the stock by a little bit. And it doesn't make sense anymore. And once it stops making sense, once the stock goes down and reverses and it loses an important support line, what happens? The market maker who's been accumulating a huge position in Tesla because folks are buying calls, well, they have to dump now. And we see a big flush down. Now, the 200 calls from yesterday, that particular contract, the volume was about 200,000, meaning about 20 million contracts of Tesla shares were traded based on one contract alone. The 200 calls with the expiration date of this Friday. That's insanity, that's lunacy, and it means that the gamma squeeze is coming to an end. Now, each contract represents 100 options. Each option represents one share, the stock. So when we see 4 million contracts traded today, that means 400 million shares. When we see 200,000 contracts traded for specific call options, that is 20 million shares in notional volume. So you got to keep that in mind. But here it is at number 2, Google. With around 1.6 million contracts traded today, they're buying the dip, of course, with about 70% of the volume for calls, not puts. But here it is at number 3, Nvidia, with around 1 million contracts traded today. Look at this, about 53% of those were puts, not calls. No wonder why we saw a reversal in Nvidia, and we have a reversal candle confirmed today. On to the unusual activities that took place in the options market today, and we're going to skip Lyft because obviously whoever bought these contracts is holding the bag right now. Whoever sold them, well, they scored big. So we're going to do MSFT Microsoft. The AI chat GPT mania goes on, and somebody bought the 285 calls for the expiration date, February 24th, with expectations that Microsoft will move higher and gain more than 8% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $1.6 million. And then what about the ticker SQ Square, aka Block? Somebody's bidding for upcoming upside for this name, and they bought the 81 calls for the expiration date, February 17th, with expectations that the name could move higher and gain more than 6% by the expiration date. They paid around $1.50 a piece to enter this trade, all in all, spending around $2 million. Last but not least, what about the trade for the ticker ARKKK for Tesla with Kathy Wood? Now, Mama Kathy having a great year so far, but she's about to be taken behind the woodshed, so be careful here. But somebody believes that the rally has a little more juice to squeeze. They bought the 45 calls for the expiration date, March 3rd, with expectations that the name will move down and lose more. Maybe that's what's going to happen. But the guy or the gal betting that the name will move higher and score gains worth about 11% or more by the expiration date. They paid around 70 cents a piece to enter this trade, all in all spending around $500,000. When it comes to the heat map, what do we see here? Are we seeing a rotation? Are we seeing risk off versus risk on? Not really. But we're seeing segments of the risk on getting absolutely shot. We're talking about, of course, the big caps, Apple, Microsoft, Amazon, but especially Google, and now Meta. Meta broke in support, and now it's flushing down. The cyclicals are weak. The stores, the airlines, the reopening names, banks are weak. The yield-sensitive names such as in utilities and real estate, Blackstone, the home builders, Home Depot, all down. And as the dollar made a significant rebound, we also have weakness in metals and weakness in energy. But we have some outliers here. And the question is, curious why CVX and SLB are down when XOM, XLE, and BP are up. Well, Exxon reported earnings recently, and it's still moving higher. BP, similar story. I believe BP reported overnight, and they smashed records, so the name is moving higher. Now, the problem with CVX, and I talked to a lot of managers, and they say our clients are calling and saying, hey, this share buybacks with Biden threatening, why not just book profits? Maybe he's going to do something here. So there was a lot of fear about a backlash by the Biden administration. But I say the company said, we got to put here. We have a floor. We have assigned over $90 billion in share buybacks. So as the stock goes down, Chevron is buying. And I like that dynamic. And now that we're seeing a divergence between Chevron and Exxon, I'd rather buy the dip in Chevron, not chase Exxon. When it comes to SLB, that name's up big since last year. So we have folks, the geniuses that they are, they're taking profits from SLB and they're chasing the mania in Tesla and Nvidia and Apple and all of that. Now we need to see a change in sentiment where the assumption of the rotation out of energy into technology is proven wrong. And we're getting closer to that because yields are popping higher, the dollar is moving higher, which is not good for energy, by the way. But with yields moving higher, it means that we have more tightening to come, and that will squeeze the valuations of overvalued tech names. Now, we don't have an overvaluation problem in energy, and the earnings are pretty good. And by the way, oil prices actually went higher last month. Now, if oil goes down below 70, then I'm going to say, okay, you can't be bullish here because energy stocks become relatively overvalued. But with the commodity prices holding up and actually moving higher, I still see the opportunity in buying these names. But right now, if you're buying Valero, if you're buying Halliburton, if you're buying SLB, if you're buying Chevron, you're facing a stampede out of these names. So your buying volume is being overwhelmed by exiting volume. And this is the problem right now. Once that stops, once they realize that, hey, the value is still in energy, not in technology, then we're going to see flows coming back into energy and perhaps into the value names, be it consumer staples, be it big pharma. Look at AbbVie today, popping higher on the heels of earnings. And I think this will happen. It's just a matter of time. Now, when we talk about corporate news, let's talk about Tesla because this was the outlier today. Tesla was actually up by about 3%, although off the highs. And the reason is, number one, the regulators are saying that the autopilot program has no association at all with the crash in Texas. That was due to reckless driving. So Tesla feels vindicated here. On top of that, perhaps the most important catalyst is Elon Musk pumping again with the master plan part 3 that he's going to unveil. And I say, where are the robo-taxis, bro? Where's the Cybertruck? Roadster? All empty promises by Reverend Elon. And my hunch is he's just pumping so he can dump later on. He needs the money. When it comes to Coinbase, the name's down big today. How about those Coinbase puts? Steak and lobster, baby. Part of the reason is Bitcoin went down big, but the SEC waking up from the coma, of course, a day later and dollar short, but they took action against a tulip exchange called Kraken. And they're cracking against Kraken, and therefore Coinbase is down. When it comes to the heat map for the ETFs, again, no major move in the dollar on face value, but remember, it rebounded big time. The rebound was big, and it recaptured 103 as support. So naturally, we see oil down, we see anything dollar sensitive down, with exception of the Chinese ETFs, FXI, MCHI, all moving higher. Now, why would that be? You look at copper, why is copper up? We talked about the shortage of supplies, but in reality, we also have China reopening optimism. And the dips will be bought in China because we have this consensus that we have an easy market in China. We have the monetary policy in China being eased with rate cuts versus rate hikes in the US, in Europe, in Australia. So money's flowing and buying the dip in China. How long will that last? We need to see the reopening optimism, reopening assumptions being challenged. For now, there is no significant or credible challenge yet, but it is coming. We also got yields moving higher in bonds, specifically the 30, and therefore yield-sensitive names were down. IYR, real estate down. Utilities, XLU down. When the risk-free rate goes higher, why would you take the risk and buy utilities? When yields go higher, technology goes down. We're seeing technology down. And for now, these are the dynamics. Of course, we need to get the CPI out of the way and see where the dollar and yields are going to be. And if they go higher, we will see more pain across the map. Now let's talk charts and then wrap it up. And I said this today, all indices remain range bounded, but number one, some big NASDAQ stocks broke key supports. Number two, the 30-year bond auction bombed, indicating higher yield expectations. So the buyers said, we're not going to buy right now because we're expecting higher yield, and it's being offered right now. We believe that inflation is going to rebound, that the Fed will do more, and therefore we're not going to buy the auction right now because we think we're going to get better yields. Now, if you combine higher yields with certain tech names breaking support, it is a no-brainer why we got a reversal today. I also said Lotto ticket alert, SQQs, 38 calls, tomorrow's expiration, 8 cents apiece. Good luck. Now, why did I say that? Again, it's a Lotto ticket, but on the hourly chart, we have higher lows. We have 36 as resistance. Now, before 36, we got a gap above, and the SQs closed the gap and continued to move higher, indicating it's going to hit the next resistance, which is 36, and then we take it from there. Now, the Lotto ticket went from 8 cents apiece, and it closed at about 16 to 18 cents. So it's already up 100%. And therefore, I said, take some off the table and let some roll if you want to play it. It's a lotto ticket after all. But if we get a pop in the morning, make sure that you book your profits right away and go home. You don't want to roll the dice and extend this more than it should. This is just some weekend money for you to buy some flowers to your significant others. You're welcome. And with that out of the way, what about the SPY, the S&P 500 30 minutes chart? What do we see here? We have the G and C, gap and crap, pop higher, then immediately a flush down all the way till the end of the day. That is bearish, not bullish, in case you didn't know. On top of that, 410 was broken as support. Now we got 405. The chart is getting a little oversold, so I'm not going to be surprised if I see a pop higher in the morning based on whatever, fill in the blank. But we could see another GNC. If that is the case, if we close below 405 for the week, that would be an ominous signal. And the reason is it erases the entirety of the post-FOMC rally. The assumption in post-FOMC is, oh, the Fed is playing ball. The Fed is now confirming that we have a soft landing, number one, and we have a disinflationary process. If the market says, you know what, I'm going to reverse all of that assumption, what does that mean? That the market is no longer believing in the soft landing, and the market perhaps is now believing in higher inflation, and that comes with higher rates, and that also comes with contracting valuations. Watch what the market does, because that will be really important. Now we can look at it another way. We have a support line, higher lows, in a consolidation pattern with lower highs, and we now have a break. A break is to the downside. That is negative, that is bearish, not bullish. But watch 405, that would be the most important closing for me, above or below. Here's the daily chart for the continuous contract for the S&P. We now have a confirmation because the RSI is no longer in positive divergence. It is now actually in negative divergence. On top of that, the MACD has given us the signal, the confirmation. The bullish momentum is over now. We are moving into bearish momentum. Now you gotta wait for the weekly closing if you want to have a solid confirmation, but I think I've seen enough here because the support of 4100 is lost. A closing below 4100, that will confirm the loss of momentum, but the cherry on top would be closing below 4037. That will seal the deal that we have a reversal on hand here. We zoom in to a 30 minutes chart for the continuous contract for the S&P. Look at this. At the time I took this picture, it appears that the support of 4100 was broken and the chart ran a retest and it failed so far. Now if this pattern continues and we see lower lows in the 30 minutes, you got a confirmation that 4100 is lost for good. What about the Qs? 30 minutes, what do we see here? Believe it or not, despite the GNC, it remains within range. Support 372, you can roll that down to 300, while the resistance stands at 308.55. But again, is the action bearish or bullish? The answer is it is bearish. But the RSI is becoming a little oversold here. I would not be surprised to see a rebound in the morning. Maybe that would be another gap and crap. That would be an ominous sign. Watch 300. If that support is lost and we have a weekly closing below 300, we got a problem here because it confirms the reversal process. When we look at the daily chart for the continuous contract, unlike the SPY, we do have a confirmation in the RSI because it is in negative divergence, but not yet in the MACD. Despite all of that, it appears that the resistance of 12,766 is a tough nut to crack, and the chart doesn't have the energy to crack above this number. But the confirmation that that assumption is the right assumption would be a weekly closing below 12,339, or better yet, below 12,207. IWM, if you believe it is a leading indicator, it is not saying good things. 30 minutes chart, we have the GNC, have a typo here, but gap and crap, and it lost support. The most important support, 191.5, and now it's standing at soft support at 189.84. Can it catch a rebound from that point? Yes, it could. But will it close and crack above 191.5? That is the challenge. If it fails and moves down again, it's going to lose 189.84, and it's going to go down all the way to 188, then we see if that's going to hold or not. Dixie, what's going on here? Initially down big, but look at the massive rebound. It got 103 again as support, and now we have a bull flag consolidation pattern. Plenty of room in the momentum indicators, be it the RSI or MACD, for the name to move higher if it wants to. Of course, it is waiting for the green light by the CPI to pop higher. But the writing is on the wall here. We know where the risk is. The risk is for the dollar to pop higher, for equities to go down. When it comes to gold, we talked about a bear flag consolidation pattern. The dollar has a bull one, gold has a bear one. It is playing out. We gotta see how 1,842 holds up. When it comes to Brent oil, the daily chart, it is facing a tough resistance here at 85. But oil bulls, the chart must make a higher high as soon as possible. Otherwise, we're at the risk of the chart moving down, finding 85 as a tough nut not to crack. It loses the trend line again. And here we go. We have to talk about 77 as support. A lot of nerves will go haywire among oil bulls if we go back to 77. What about the 10-year yield? What do we see here? Bull flag pattern. I talked with a lot of bond traders today. They say 3.8 is in the bag. And if the CPI comes out hot, we go all the way back to 4. But most importantly, they say look at the 2-year. The 2-year is actually moving higher at a rapid pace. We have a bull flag within a bull flag, and the assumption is the bull flag should take us all the way to 4.88 on the 2-year yield. If that is the case, you will see a reckoning in the equities market. TLT, what's going on here? Nothing new. It should move down. We have 103.5. I don't think it's going to hold. Then we go down to 100 and see what happens. VIX, 4 hours chart. What's going on here? It should be bullish. The VIX should be popping higher. But again, can you believe the VIX? That is the challenge here. If we go with the technicals, it should move higher because we're above 20. It is support now. We have positive divergence on the RSI. This is a 4 hours chart, by the way. The support has been tested over and over and over again. It's good to go. We should go higher in the VIX. Now, keep in mind the technicals alone. What about the psychology? Now that the sentiment is changing from, oh, soft landing, the Fed is going to back off, inflation is dead, to maybe inflation is not dead, the bond market is not fighting the Fed anymore. It appears that Powell is fighting the Fed, and the dollar is rebounding higher. We have a lot of indicators here that say, watch out, you gotta be cautious here. The sentiment is changing. And if that is the case, we will see a stampede on hedging. And in this case, the VIX should, keyword should, move higher. What about the big kahuna, Apple? 30 minutes chart. What do we see here? We got the gap and crap, closing at the lows. So this is bearish, but the good news for the bulls, it didn't crack below 150, the important support. So we don't have a confirmation here, but it could come really soon. So watch out. And better yet, the VIX remains low, around 20. The puts, the hedges, really cheap. If you own Nvidia, if you own Apple, if you own Tesla, any of the big caps that ran really high year to date, why not hedge? Why not lock your gains? Buy some put options, lock some gains in case we go down. If we go down, those put options are going to protect you. And they're really cheap right now. But who's to say they're going to stay cheap when we have the CPI and more earnings coming? They're not going to stay cheap for too long. Tesla, a daily chart. What do we see here? Despite the gap, we do have a reversal candle. We have a topping indicators in the gamma squeeze. The risk versus reward says you got to go short Tesla. You got to book some profits here. So today I did double down on my position. The risk versus reward, if you look at the overbought versus oversold indicators, they say you got to look for downside coming, book some profits, and bet against the name. Now the timing becomes challenging, but if you give your options enough time, you're going to score. Keep in mind that back in December, I said I'm going to go ahead and buy Tesla calls. Now we had to tune that in because I bought January and then I rolled all the way to February. And you can look at the gains since then. The stock shot up significantly higher. Now I'm saying, folks, the opportunity in chasing Tesla, that's over now. The opportunity right now is to buy put options with Marsh and beyond expiration, You're gonna score. The risk versus reward says the name is coming down and it's gonna go to 190, 180, if not all the way down to 150. So word to the wise. When it comes to Bitcoin, a daily chart, look at what's going on here. If Bitcoin is a leading indicator to risk on, it's not saying good things. It appears that Bitcoin lost the battle of 23,189. It's not going to make it here. So it has to go all the way down in a retest to 20,593.34. Then take it from there. But my hunch is with the dollar moving higher, we could see the head and shoulder formation. The good news is, if you can't afford flowers, you can buy your significant other a tulip instead. And it's going to be cheaper. The disinflation process is here. Anyways, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the University of Michigan Consumer Sentiment Index and inflation expectations. On top of that, we have a bunch of Fed zombies speaking from Governor Waller and from Philly, President Harker. Let's hear what they say. But again, I doubt it they're going to move the market one way or the other. We're all waiting on the upcoming CPI next week. Until then, this is all I got for you for now, folks. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend. Good night.
Don't need any credit, Benny. I'm a big guy. Hello, Lucy's wife.
See how long that lasts.
That's a little.
Shut your mouth, I've got something to say. Not only you have been betrayed in this season. I've got so many miles to